The European sovereign debt crisis remains front-page news as its effects reverberate throughout the global economy. Is this crisis a replay of the U.S. financial meltdown in 2008? Does it represent a systemic risk? What action should various central banks and governments take to reduce government debt levels, restore global confidence, and provide a more stable financial environment? With the recent turbulence in our global economy over the European sovereign debt crisis, has fear and short-term volatility influenced investor behavior? Are investors' economic priorities currently focused on wealth preservation? Going forward, what are the financial risks to the global economy? Will the European debt crisis take a toll on global manufacturing? Do you believe that prudence requires caution in these economic times? Or are you a contrarian who seeks opportunity in this fiscal crisis? Or would you prefer that this mess would just go away? Hello, my name is Attorney Ramsey Barawi, and welcome to Your Money, Your Life. In this segment called Is the World Broke?, we will discuss the European sovereign debt crisis. To assist me in this discussion, I've invited as my expert guest Dr. Robert Como, economist and dean of the Girard School of Business and International Commerce at Merrimack College. Dr. Como, welcome to Your Money, Your Life. It's great to have you on the program.
It's great to be on with you again, Ramsey.
All right, wonderful. Let's start first with what would you say are the root causes of this European debt crisis?
Essentially, the crisis is similar to what we're experiencing in the United States right now, and that is countries spending more than their income will allow. In most countries, financing at the government sector is done by tax revenue expenditures. To the extent that countries are spending more than their tax revenues allow, this is putting pressure on financial markets to the extent it's driving up interest rates and causing long-run debt problems that will have a tremendous drain financially going forward.
Okay. The European governments, the IMF, central banks, even the U.S. Federal Reserve, they've all sort of jumped in here. They've tried to contain this crisis. Have their efforts worked?
They've worked only partially. As you well know, the crisis is spreading. It spread after Greece, it spread to Ireland, it then went on to Spain, Portugal, Great Britain, even Japan. So clearly the ramifications of the debt crisis are spreading.
Mm-hmm. Is it fair to characterize the reaction to this crisis as queasiness, as an uneasiness over what's going on here?
Absolutely. People are unsure as to whether or not the government can actually extricate itself from this financial malaise. Can the government make the tough decisions to say we have to live within our means, we cannot spend more than our income will allow over a long-run period of time?
Dr. Como, would you say that the reaction has been reasonable or unreasonable? I mean, we've seen tremendous reaction and volatility in the markets. What's your read?
Well, it's hard to answer that definitively. Emotions obviously affect much of what happens in human behavior. And to the extent that people feel financial markets are deteriorating, they will react by becoming very, very conservative, becoming queasy, and pulling out because they're not sure what's going to happen.
Okay, so that also then would reflect investor behavior, and investors would change their behavior. They would be less aggressive in their investments. They would become, as you said, more conservative, and so we're going to see that as well with this credit crisis, so to speak.
Yeah, you're going to see consumers, basically, and investors sitting on the sidelines, parking their cash in conservative investments till they feel the financial environment has improved sufficiently so that they can have confidence that their investments will come to fruition as time goes on.
Now, do you think that's the prudent thing to do, or do you think that this particular crisis perhaps presents an investment opportunity for those who have the stomach for it?
There is no question that long-term this presents an extremely good investment opportunity. However, it depends upon one's time horizon. If one looks at the stock market as an immediate money machine, no, you're going to have trouble because I don't see any real ride recovery to any significant extent until the year 2011. But if you're willing to wait long-term, 2012, 2013, money put into the stock market today strategically will pay handsome dividends going forward, in my belief.
Now, we also know that in the fixed income market or the bond market, rates have gotten extremely low. And yet it appears that there's tremendous demand for these fixed income instruments, especially the U.S. Treasuries. Why is that so?
Security. People feel the United States government will not default. To that extent, they'd rather have 0.5% return than none at all. It's what we call in finance preservation of principal, preservation of capital. don't lose the money, as the saying goes, and that's essentially what you're seeing happening right now.
Do you think that what we've seen with the credit crisis in Europe is at all similar to what occurred in the United States in the fall of 2008? Are we kind of seeing a replay, only on a different continent?
I think you are. What you're seeing is a lack of confidence in financial markets, the inability of the system to self-regulate, to correct any deficiencies without tremendous oscillations, and you're seeing that spreading now to Europe.
Mm-hmm. Now, you know what really I found interesting is Greece is a very small player in the global marketplace. I believe, if I remember correctly, Greece only represents 2% of the European Union, and yet Greece could cause all this trouble?
Greece can cause a tension to be drawn to a situation in which governments try to run long-run deficits. It doesn't work. And to the extent that the financial markets are interconnected, what people are seeing happening in Greece brings them concern about what's happening in their country, and now they're beginning to focus on a problem that was probably there before, but now it's becoming more apparent as to what the consequences of that might be.
Okay. Now, you mentioned there were also other countries who have been affected by similar fiscal type issues. I think you mentioned Spain and Portugal. What happened in Spain and Portugal?
Basically the same thing. What happened is that governments were spending more than their income would allow, causing tremendous debt burdens, crowding funding out of financial markets, driving up interest rates. Driving up interest rates obviously curtails consumer and business spending. And when that happens, businesses contract, banks don't lend, and you have that whole cycle of a downward spiraling economy.
Well, let me back up. What do you think governments in Europe, central banks, and other countries like the United States and China, who are very much involved, what do you think they should be doing given this credit crisis?
What they should be doing is looking carefully at what their expenditures are and prioritizing their spending. That is, recognize we can't do everything we want to do. Given our income limitations, how do we prioritize what needs to be done and make that decision? Now, that's going to be very much a political decision, but short of doing that, the crisis will continue.
Do you think it's important that the United States and China and the EU and some of the other regional organizations, that they act in some sort of concerted fashion?
They need to act in some concerted fashion in the sense that they have to recognize what happens in one economy affects what happens in another. So there's going to be cooperation with terms of tax and trade policies, tariff policy, reciprocal trade agreements, things that say we're in this thing together. We can't look at a closed economy. We must look at an integrated world economy, and that what happens in my country affects what happens in yours. So we have to develop coordinated policies and approaches.
Okay, Bob, thank you. I think that's a good place for us to stop. The unfolding European fiscal crisis remains front-page news as various central banks and governments pledge support for fragile credit markets in Greece and other countries. Prior to the European sovereign debt crisis, there were reasons to believe in a financial recovery. The economy appeared on the mend. All that was missing was an increase in employment and aggregate wages, which would represent signs that the financial recovery was indeed the real thing. Then suddenly, the credit crisis in Greece arrived, followed by warning signs of a similar credit crisis in Spain and Portugal. Our financial markets reacted turbulently, characterized by significant volatility as investors worried that the European debt crisis was taking a toll on global manufacturing and commodities markets. Today, as European nations brace for the possibility of severe austerity measures, some wonder what long-term consequences these actions will have on the fledgling global economic recovery. In other words, will there be more risk to our global economy? If so, how will that affect U.S. consumer spending and any future recovery in the U.S. economy? Even though economists tell us that the economy has stabilized, it is clear that only coordinated action can have a positive impact on the global economy. It is safe to say that the current sovereign debt crisis in Europe involves numerous complexities affecting financial markets, profitability of U.S.-based multinational companies, global manufacturing, commodities markets, and the global behavior of consumers. As Dr. Como pointed out, increasing government debt levels will lead to higher interest rates and higher taxes. Dr. Como also pointed out that deflation is a possible risk to the global economy. Therefore, it would make sense to tread carefully at this time. Learn as much as you can about the sovereign debt crisis and its implications for the global economy. For as Ben Franklin is quoted as saying, an investment in knowledge always pays the best interest. Armed with knowledge, you will build a greater measure of awareness, confidence, and understanding. In closing, thanks to my guest, Dr. Como. Dr. Como, it's great to have you back on the program again. Thank you for your insights, and also thank you for some of your advice.
It's a pleasure, Ramsey. Thank you.
And as always, thank you to you, our viewers, for watching Your Money, Your Life. My name is Attorney Ramsey Barawi.